The program introduces credit derivatives and explains their role in transferring credit risk between market participants. Credit risk arises when borrowers or counterparties fail to meet contractual obligations, potentially causing financial losses for lenders and investors. Credit derivatives allow institutions to separate credit exposure from the ownership of the underlying asset and redistribute risk to parties more willing or able to bear it. Banks, insurance companies, hedge funds, and institutional investors commonly use these instruments to manage portfolio risk, reduce regulatory capital requirements, and improve balance sheet flexibility. The program emphasizes that credit derivatives have become essential tools in modern financial markets because they enhance liquidity, diversify exposures, and facilitate active risk management strategies. One of the most important credit derivatives discussed in the topic is the credit default swap, CDS. A CDS functions similarly to insurance against default, where the protection buyer pays periodic premiums to the protection seller in exchange for compensation if a specified credit event occurs. Credit events may include bankruptcy, restructuring, or payment failure by the reference entity. The program highlights that CDS contracts allow lenders to hedge loan exposures without selling the underlying asset. Financial institutions also use CDS instruments for speculative trading and portfolio management. While CDS markets improve risk distribution and market efficiency, excessive leverage, interconnected exposures, and counterparty risk can amplify systemic instability during periods of financial stress or market uncertainty. The topic further explains several mechanisms institutions use to transfer credit risk. These methods include loan syndication, exposure netting, collateral agreements, and securitization structures. Loan syndication spreads large lending exposures among multiple institutions, reducing concentration risk for any single lender. Exposure netting offsets obligations between counterparties, lowering overall credit exposure. Collateral agreements provide additional protection by securing obligations with pledged assets. The program stresses that these techniques help institutions manage capital more efficiently and improve financial stability. However, risk transfer does not eliminate risk entirely because exposures may reappear through counterparty defaults, operational weaknesses, or market disruptions. Effective governance and transparency are therefore essential components of successful credit risk transfer frameworks. Topic examines the structure and evolution of the credit derivatives market, with particular emphasis on securitization. Securitization involves pooling financial assets such as mortgages, loans, or receivables and converting them into tradable securities sold to investors. The process allows banks to remove loans from their balance sheets, free regulatory capital, and originate additional lending opportunities. Structured products such as mortgage-backed securities and collateralized debt obligations distribute cash flows and losses across different tranches with varying risk levels. Senior tranches typically receive higher credit ratings because they absorb losses only after subordinate tranches are exhausted. The program explains that securitization enhances market liquidity and broadens access to credit for borrowers and investors alike. The program also explores the role of securitization in the global financial crisis of 2007 to 2009. The originate-to-distribute model encouraged banks to relax underwriting standards because loans could be sold rather than retained until maturity. Subprime mortgages were pooled into complex collateralized debt obligations that often received unrealistically high credit ratings despite weak underlying asset quality. Investors struggled to value these opaque structures during the crisis, leading to severe market illiquidity and widespread losses. The program emphasizes that misuse of credit derivatives and excessive reliance on securitization contributed significantly to systemic risk. Weak governance, inadequate transparency, and overdependence on short-term funding amplified the collapse of confidence throughout the global financial system. The topics conclude by emphasizing that credit derivatives and securitization are powerful financial innovations that require careful oversight, strong governance, and effective risk management practices. When properly used, these instruments improve liquidity, diversify exposures, lower financing costs, and support economic growth by increasing credit availability. However, they can also introduce substantial complexity, counterparty exposure, leverage, and systemic interconnectedness. Regulators and financial institutions therefore place increasing emphasis on transparency, stress testing, collateral requirements, and capital adequacy standards. The program teaches that understanding both the benefits and limitations of credit risk transfer mechanisms is essential for modern risk managers. Successful implementation requires balancing innovation, profitability, financial stability, and prudent governance within increasingly interconnected global markets.